Welcome to the Organized Investor Show, brought to you by Tennessee Wealth Management. It's me, your host, Erik Ainge, and today we're diving into one of the most requested topics from our listeners and people in our lives. We're doing Fisher Investments, the autopsy of a steak dinner, and why you should avoid them like the plague. We're going to compare Fisher Investments' committee-based model to our local approach right here at Tennessee Wealth Management, and I promise you the difference is going to blow your mind. We got the full team here today because this is the kind of show where you need multiple perspectives. Let's start with Megan Hubbard. Megan is Jerry Goodman's daughter. She used to be a first-grade teacher at CAK. She has a master's degree in curriculum and instruction, and she's turned out to be one of the smarter people I know that I've ever worked with, and that is Megan. Next to Megan is Jerry Goodman. Jerry has 43 years in the industry. He's a certified financial planner, and frankly, he's the reason that we can even do a comparison like this because he has watched every variation of financial advisor model for 4 decades. My wife, Susan, here with us as well, studying for her Series 7, which means she's absorbing the industry from the ground up and catching things the rest of us have gone numb to in and around the business. And then you got me. Former UT quarterback, New York Jets quarterback, host of the Erik Ainge Show on the Sports Animal. And the reason I'm on this show is because I was one of those people who got bombarded with Fisher Investments commercials and thought, what exactly are they selling? So let's hit you with some numbers right out of the gate and get this thing going.
So in 2025, our average client was up 36.3% net of all fees and costs. The Dow Jones Industrial Average was up about 13% in that same year. That's a gap of over 23 percentage points in a single year. Over 3 years, our average client has done 19.3% annually versus 13.2% for the Dow. Over 5 years, 13.3% annually versus 9.4% for the Dow. Over 7 years, 16.7% annually versus 10.1% for the Dow. And those numbers are published at theorganizedinvestor.com alongside the last 4 digits of actual client accounts. So anybody can verify for the math. I'm going to have my dad break down what Fisher Investments is actually selling people.
Erik, this is rather fascinating because Fisher Investments is completely transparent about their business model. So it's not a criticism. It's just about the math, okay? They have 200,000 clients, and if they have a 5-person investment committee. That means each committee member on that committee is responsible for making investment decisions for 40,000 clients, 40,000 per decision maker. Now, when you call Fisher, you don't talk to people who actually pick the stocks. You talk to who they call their investment counselor, okay? The person that is essentially their customer service person. They have access to your accounts. They see your balance. They remember your birthday. They send you a little holiday card.
Oh.
Yeah, exactly. It's kind of fun. But they can't explain why Fisher bought Microsoft last week or how they've done anything in terms of their decision making. The actual investment decisions are made by 5 people in Camas, Washington, who you'll never meet, you never talk to, who have no idea you even exist as an individual. Now think about that practically.
And if you have a question about why your portfolio is underperforming, or why Fisher chose one ETF over another, or why they made a specific allocation decision, your investment counselor has to submit that question up the chain. It might take days or weeks to get an answer, and when you do, it's usually generic market commentary that could apply to just anyone. You're paying premium fees for a customer service experience, not portfolio management expertise.
And Dad, this is where it gets interesting from a teaching perspective. So Fisher actually charges between 1 and 1.5% annually. Typically, that's around 1.25%. And on a $1 million portfolio, that is $12,500 per year. But what are you paying for? Well, you're paying for a relationship management and access to committee decisions. You're not paying for someone who knows you, your situation, and makes decisions specifically for your portfolio. It's like calling your doctor with the chest pains that you're having and getting medical advice from the receptionist who has to ask someone who has to ask someone else about what to do for you.
Can I just jump in here? Because studying for my Series 7 has opened my eyes to how this industry actually works. Fisher openly promotes this separation between service, sales, and portfolio management. That's their published business model. But from a client perspective, you're paying premium fees for what is essentially a middleman operation. The investment counselor you talk to every quarter has never made a single investment decision for your own account. They are literally reading you information that was decided by a committee in another state.
And this is where my football analogy comes in for this segment. In football, you have a head coach who makes the big strategic decisions, but you also have position coaches who work directly with the individual players. The quarterback coach knows his quarterback personally, their strengths, weaknesses, how they perform under pressure. Fisher's model is like having one head coach for the entire NFL, making all the play calls for every team, while local assistants just kind of relay some information. That quarterback coach has no idea who you are individually, but he's calling your plays anyway. Here at Tennessee Wealth Management, Jerry and Jared are both the head coach and the position coaches for every client. They know you personally. They make decisions specifically for your situation, and then they can explain every single trade.
And Erik, let me give you a real story that illustrates this perfectly. So we had a woman named Karen who came to us after 8 years with a large national firm that uses the exact same model as Fisher does. She loved her advisor. She had a great relationship with him. They sent her, birthday cards, holiday cards, the works, made her feel very loved. But when she asked about underperformance versus the market, her advisor said he would check with the investments team. If you could see me, I'm putting that in air quotes, okay? So he's checking with the investments team. Okay, well, who's the investments team? That's when Karen realized her trusted advisor, again, air quotes, if you could see me, had never made a single investment decision in 8 years. He was basically kind of like the middleman, if you will. His job was relationship maintenance, not portfolio management.
So here's the kicker on this story. Karen, which actually is with an E, she was paying 1.35% annually, which is about $16,000 per year for her portfolio. She did that for 8 years. Folks, that's $128,000 in fees to someone that could not explain a single stock pick, okay? Now, when we showed her our track record, the 5-year numbers I mentioned earlier that we talked about, she realized she had left hundreds of thousands of dollars on the table because no one had ever given her something to compare to.
And this gets to the heart of what we're really talking about today. Most people have never actually compared their advisor's performance to a benchmark. They get a statement, the number is bigger than last year, and they assume everything is fine. But fine is doing all the work in that sentence. Fine compared to what? If the market was up 25% and you were up 7%, that's not fine. That's a problem.
All right, right in the middle of this segment, I want to talk about the Organized Investor workshops that we do, because this is exactly when people need to hear about it. Well, I think so, so I'm going to do it anyway. We do it every month at Chesapeake's on Parkside Drive in Knoxville, 6 p.m. You get a meal, an adult beverage if you want one or two, and a 40-page workbook. We also talk about our estate planning offer, free estate planning documents through our subscription partnership with Trust and Will. You got a chance to win a signed football by me. This isn't the high-end steakhouse environment designed to soften you up for a sales pitch. This is with us. We're casual, right? It's at Chesapeake's. It's educational. There's no pressure. You can sign up. Again, it's super easy. Theorganizedinvestor.com, or you can call 865-415-2058. The difference between our workshop and what Fisher offers is the same difference between our investment approach and theirs. Local, personal, and focused on education rather than closing.
And I want to emphasize the estate planning piece because people gloss over it. So a revocable trust, a will, a power of attorney, healthcare directive at a real attorney's office can actually run you anywhere from like $1,000 to probably $5,000. It can get very pricey. We include those documents through Trust and Will at no extra cost to clients because we have an unlimited annual subscription. Whether we help people do 14 of these in a year or 914, it doesn't cost us any more money. That's real money back in your pocket. And here's why that matters in the Fisher comparison. Fisher doesn't include estate planning. It's a separate service you have to find elsewhere. So you're paying their premium fees and still having to solve the estate planning problem on your own.
So let me tell you about the 2% improvement option that we talk about, okay? Because this is where the Fisher comparison really lands. Our goal is to improve someone's performance, their overall investment performance, by at least 2% annually over what you may have already been making at some other typical firm. Now, on a $1 million portfolio over 20 years, that compounds out to $485,000 in additional wealth. We get there through 4 main decisions: lower fees, hidden layers, and no fee stacking. We avoid mutual funds because mutual funds are bloated and very tax inefficient. We use individual stock ownership because we own actual companies, not some fund that owns thousands of these companies. And we're very selective on where we put money. Currently, we have about 95 stocks with about 1% in each one in these portfolios, not 3,000 to 4,000, which basically dilutes you down to nothing. See, our team basically invests in individual stocks. Fisher also uses stocks, but also uses some exchange-traded funds. So we applaud them for not using a lot of funds. So we both agree about that, but there's a lot more control with these stocks instead of the funds. And basically, there's a lot more control over both the investments and the taxes. But you have no control over what goes inside those packaged products and that most people own. Now, a lot of these same packaged products are being selected by some committee or some portfolio manager somewhere else. There's not as much flexibility in terms of how much money can be invested.
And Jerry, this is where the flexibility piece becomes huge. During COVID in 2020, during the banking crisis in 23, during the tariff scare in 25, you and Jared were buying when everyone else was panicking. You made over 12,500 trades in a single day during the tariff scare. That kind of speed is impossible with a committee model. While Fisher's committee was meeting to discuss whether they should do something, you guys have already done it.
And this is the fundamental difference between our approach, the Tennessee Wealth Management approach, and the Fisher model. Fisher separates relationship management from investment decisions. Well, we integrate them. Jerry doesn't manage your portfolio. He knows you personally. All right. Same with Jared. I mean, the whole office. He can explain every trade, every decision, every allocation. You're not paying for access to a committee decision. You're paying for someone who knows you, your goals, your risk tolerance, and makes decisions specifically for your situation.
And let me add one more real story before we set up for segment 2, okay? So we had a gentleman named Paul who came to us after 3 years with Fisher. He had a great relationship with his investment counselor, but when he asked about specific holdings due to lagging returns, she had to reach out to the investment team. Again, there's my air quotes being put around that investment team. It took a week to get an answer, and the answer was generic market commentary that could have come from any financial website. Nothing portfolio specific, nothing that explained why Fisher made the decisions that they made for his account. That's when Paul realized he was paying $15,000 per year to a middleman.
They need like the Batman signal, like, exactly. Quick, the investment team.
Get downtown. Well, basically, Paul's story, it's everywhere, folks, which is why we keep beating this drum and bringing this up, okay? You should be able to ask your advisor, what stock did you buy from me last week and why'd you do it, okay? Get an immediate, detailed answer. If your advisor has to check with somebody else 2,000 miles away, you're basically paying for the wrong service. In segment 2, we're going to crack open that steak dinner seminar situation and show you why you're really just paying for an expensive sales presentation disguised as a meal. And we're going to contrast that with the workshop approach that we have, where education actually comes first.
Education should always come first, Jerry.
Exactly. I would agree with that.
Yes, you would, Megan. And, all right, the Fisher model, it works great for them. We're talking about it, but it does. It works great for them. 6,300 employees, massive marketing budget, nice offices. But the question is, does it work for you listening right now and your portfolio, your retirement? We'd like to compare our performance to theirs, but guess what? They don't publish it, at least as far as we could find.
Couldn't find it.
We did look.
Yep.
Our track record is posted on our website, but you can Google search until the cows come home. I bet you're not going to find theirs. I wonder why they don't share it on zillions of commercials that they run every year. Well, probably for a good reason. When we come back, we'll show you what happens when financial firms prioritize sales over service and why the free steak is never actually free. It's me, Erik Ainge, and you are listening to the Organized Investor Show brought to you by Tennessee Wealth Management right here on Newstalk 98.7.
Want to meet the team from the Organized Investor in person? Join us at a free Organized Investor workshop. You'll get a 60-page workbook, a great meal, and learn how to get free estate planning documents through our partner Trust and Will. Our next workshop is Wednesday, May 20th at 6 p.m. at Chesapeake's Restaurant on Parkside Drive in West Knoxville. There's no cost or obligation to attend, however, seating is limited. So reserve your spot at theorganizedinvestor.com or call 865-415-2058. That's 865-415-2058. Erik Ainge is the host of The Erik Ainge Show on 99.1 The Sports Animal, weekdays from 9 to noon. Erik, his wife Susan, Megan Hubbard, and Jerry Goodman are all affiliated with Tennessee Wealth Management and Prospera Financial Services in Dallas.
Welcome back to the Organized Investor Show, again brought to you by Tennessee Wealth Management. It's me, Erik Ainge, former UTQB, New York Jets clipboard holder, I guess you could call me there, and overall fan favorite. And you're listening to our show. In segment 1, we broke down the Fisher Investments committee model, showed you the difference between paying for relationship management versus paying for actual portfolio management. With us again, Megan Hubbard, Jerry Goodman's daughter. She used to be a first grade teacher at CAK. She's got that master's degree in curriculum and instruction, and she helps us make the hard things simple. Jerry's been doing this for 43 years. Certified financial planner, the guy who has seen every sales tactic this industry has ever invented, and kind of an innovator himself. And of course, my beautiful wife, Susan, studying for her Series 7 and hanging out with all of us so we can do some radio and help bring people along as well. Before we dig into the autopsy of a steak dinner, let me quickly recap performance numbers for anyone that's just joining us, hasn't heard us before. In 2025 at Tennessee Wealth Management, our average client was up 36.3% net of all fees and costs. 3-year average 19.3% annually. 5-year average is 13.3%. 7-year average 16.7% annually. All those numbers are posted at theorganizedinvestor.com with the last 4 digits of each account number so you know the real numbers. Now, Megan, let's talk about why someone would need a ribeye to sell financial products.
Well, Erik, the Steakhouse Dinner Seminar is really a psychological operation dressed up as a meal. Think about it. They pick the nicest restaurant in town, they put on a slick presentation, they serve you a ribeye, they pour wine, and the whole time you're sitting there thinking these people must really be doing well if they can afford this. And that is exactly the reaction they want you to have. Then the presentation starts and it's glossy, it's kind of scary at some points, and the entire thing is designed to move you toward one outcome, which is buying an annuity or some other product with a massive surrender period. The math is actually pretty simple. If the commission on the product they are selling is 6 or 7%, and they bring 20 couples to a dinner, and even 3 of them, buy a $300,000 annuity, that dinner paid for itself 10 times over. You were not the guest. You were actually the target.
And I hate to say it, but she's not exaggerating, not one little bit. I've been in this business for 43 years. The steakhouse dinner industry basically is a multi-billion-dollar pipeline, specifically because it works. The reason I got my CFP and the reason we run our firm the way we run it is because we saw this industry that's willing to do, basically to dress up a bad product, let's put it that way, and call it a solution. Annuities are not evil in the right spot for the right person. But the way they're sold over a ribeye steak dinner is particularly designed to confuse the buyer and lock up the money for 7, 10, maybe even 12 years. And the person doing the selling, they don't even send you a bill. They get paid up front by the insurance company, and you'll never actually see the check leave your account.
Can I jump in here? Because I am studying this stuff right now, and the level of complexity is borderline insane. There are products with 10 pages of disclosures and surrender schedules and income riders and death benefits. And I'm sitting there with a textbook going, how on earth is somebody supposed to evaluate this over a cocktail and a steak? Well, the answer is they're not. It's not supposed to be evaluated. It's supposed to be sold. That distinction is the whole problem with the steak dinner model. And the scary part is that the Series 7 is just the baseline license. You can pass a test and sell this stuff to the public with no obligation to put the client first. I'm looking at these product specifications in my textbook, and some of these annuities have surrender schedules that change based on market performance. Bonus rates that disappear after the first year, income riders that sound great until you read the fine print about when they actually start paying. That complexity is intentional. If you could easily understand what you were buying, you may not buy it. The confusion is part of the sales process, not an accident of product design.
And this is where I want to run my football analogy for this segment. If I'm only going to do one, we'll see. But in the NFL, when the defense wants to confuse a quarterback, they don't line up and show you exactly what they're going to do. They disguise the coverage. Like a steak dinner. They show up in the pre-snap here. They're looking like it's going to be cover 2, and then they rotate into single high, and they blitz the Sam off the edge, and that's right when you get the ball moving. That's what the steak dinner is, guys. It's disguised coverage. Pre-snap, post-snap. You think it's a dinner? Wrong. You're actually at a sales presentation where the disguise is a ribeye and a glass of cab.
I love that analogy.
And here's what makes the autopsy of all of this so interesting. So when you break the dinner open and you look inside of it, what you find is this enormous gap between what the advisor tells you they can do and what their actual numbers look like. Nobody at a steak dinner is showing you a performance report. Nobody's printing out the last 10 years of their returns. Nobody's walking up to you, with their last 4 digits of their real client accounts and saying, hey, check my math. Because if they did, you would be leaving that dinner and you would never be coming back. The whole evening is choreographed to avoid comparison. They talk about hypothetical returns, theoretical scenarios, and what might happen if you do nothing. They show you scary charts about inflation and market volatility, but they never show you the actual track record. It's like the restaurant that talks extensively about how wonderful their food is, but never lets you see a menu with prices or taste a sample before you actually order the food.
So I'll tell you a real story here because I think this may make it concrete. We have a couple come in the office a few months ago. They'd been at a steak dinner, like we're talking about, that very week. They'd brought in a brochure, kind of glossy, heavy paper, as you might expect, and they wanted basically us to take a look to see what they had been pitched. And it was a variable annuity. The surrender period was 10 long years, and the all-in cost was about 3.4% per year. Those are the internal expenses. When you add up all of the mortality expense, the rider costs, the sub-account fees, blah, 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 okay? 3.4% per year for 10 years on $400,000. Do the math on that.
So if you do the math, that is roughly $136,000 out of their pocket over the surrender period just in costs. And here's the kicker. The couple did not understand what a surrender charge was until we explained it to them. They thought it was like a bank CD where you lose some interest if you cash out early. They had no idea that the surrender charge starts at 9 or 10% in year 1 and slowly steps down.
That means if they needed the money in year 3 for a medical emergency, they would pay a 5 or 6% penalty on the full amount. That is $20,000 or $24,000 out of pocket just to access their own money. And that was never explained at that steak dinner. It was in the fine print, but who reads 47 pages of fine print over dessert?
And here's the part that drives me nuts as a former teacher. The advisor that sold it to them made a 7% commission on the front end of that. That is $28,000 for one evening's work. No wonder they could afford the steaks. But the couple would never have known that, right? Because they didn't teach them what they really should be knowing about. They would have signed the paperwork at dinner, felt great for a week, and then slowly, over 10 years, watched their opportunity cost pile up while the person who sold it to them was already at the next steakhouse selling the next one.
And this is where the 2% improvements that we talk about, that message we talk about, really lands home. On $1 million over 20 years, a 2% annual performance improvement that we talk about is equivalent to, when you compound it, $485,000 of additional wealth. That couple at the steak dinner was about to lock up their money for 10 years in a product that had virtually guaranteed they would never see any kind of returns close to what our clients are seeing, okay? They were trading flexibility and growth potential for the illusion of safety and a free meal. Now, this is going to sound rather strange, but we're going to stop talking about these steak dinner seminars and invite you to actually a real-life educational event, which we do every month. We do it at Chesapeake's on Parkside Drive once a month at 6 o'clock.
We call it the Organized Investor Workshop, and it's a complete opposite approach to everything that we've been talking about. Yes, we do serve a meal, not a steak dinner, but a meal, a really nice one, actually. Some adult beverages, and you get about a 60-page workbook. We talk about our free estate planning that we offer through our online partner, Trust and Will. We have a shot at winning a signed football by me, but it's what you will get. It's not a sales pitch. Nobody's going to follow you to the parking lot. No one's calling you 5 times a week. You can sign up for our Organized Investor Workshop at theorganizedinvestor.com, or you can call 865-415-2058. The whole point, you walk out smarter. You didn't sign up for something for 10 years of a commitment, and you can't surrender it, and you don't understand it, and you're not going to like it. That's not what we do.
And honestly, that is one of the reasons I'm enjoying studying for my Series 7 while surrounded by this team, because I get to see the philosophy up close. The workshop is not about closing anybody. It's about giving people enough information that they can make a real comparison. And this leads to the part I really want to dig into, the reason people don't compare advisors in the first place.
And I want you to think about that for a second. Most people in America have never actually compared their current advisor's performance to a benchmark. They've never asked for real numbers. They've never seen a verifiable account statement with real returns, and that is exactly the vacuum that the Steakhouse Seminar exploits.
Erik, it is one of the most important questions in all of personal finance, and I think the honest answer is embarrassment, really, plus probably some confusion. If you don't know how to evaluate returns, you don't want to look like you don't know, right? Nobody wants to look like they don't know how to do something. And most people have never been taught how to read a statement. So they sit with their advisor once a year. He brings coffee and pastries. He says the market was rough this year, but your account is doing fine. And they just nod. They don't know what questions to ask. They don't know the word fine is doing all the work in that sentence. As a former teacher, I can tell you if you don't give people the vocabulary, you can't expect them to ask the right questions.
And in 43 years of watching this, I'll tell you something that's even more striking. It's almost never the client's fault. The industry is designed to kind of confuse. That the statements are designed to be confusing. The fee disclosure is buried inside some 9-page disclosure document full of footnotes. There are terms in there we internally call the Da Vinci Code statement because you practically almost have to be a cryptographer to figure out exactly what you're paying for. And when clients ask questions, they often will subtly make you feel like you're being difficult, like they don't really understand. And when the reality is that no human being is supposed to be able to parse through all those documents very easily. It is a feature, it's not a bug.
And let me underline that from a learner's perspective. The industry language is specifically designed to sound more complicated than it is. They don't say fee. They say expense ratio, 12B to 1 fee, mortality and expense charge, rider costs, contingent deferred sales charge. Same thing, it is all money leaving your account. But if they called it what it was, you would compare. And the moment people start comparing, the whole illusion collapses.
And I lied because here comes my second football analogy. As you're talking about that, in football, we have a concept called checking down. When you're the quarterback, you drop back. The primary read, it's not open. The second read, maybe not there. And instead of forcing the throw, quarterback checks it down. You find the running back on a little hob route, little flat route. You check down, right? The stake dinner industry has trained an entire generation of investors to check down their entire financial life. You don't get the explosive play. You don't get the touchdown. You just get a safe little dump off that looks like you did something, but really the clock ran out on your retirement while you were busy feeling safe because you said yes at a steak dinner.
And the funny thing is, people often don't even notice they are checking down for years because their statement shows up and the number is bigger. Well, my account grew, so I guess I'm fine. But they didn't compare. The S&P was up 25%, theirs was up 7%, and nobody told them that that was a problem. That is the autopsy right there. It's not that these people got robbed in an alley, it's that they got softly drained over 2 decades while being told it was fine.
Fine, it's fine.
Erik, let me put you on the spot. Why do they call it a check down?
It's the easy thing, safe. It's all but a guarantee, so, hey, well, I could force this one, I could take this chance, but I'm going to check down. Your reads normally go top down, so you're going top, middle, check down.
I might understand that.
I do not.
Well, in financial, it's the steak dinner.
I got you. Well, so moving on, this is where the 4 decisions we talked about in segment 1 really become so critical. Lower fees, avoiding mutual funds, individual stock ownership, and selectivity. Those 4 things. Those 4 decisions compound year after year, and that's how you're going to build this 2% edge that we're talking about. None of those 4 decisions is actually a secret. This is not proprietary. They're not patented. Any firm in America can do exactly what we do, folks. The reason most of them don't is because the current model for them is really too profitable for them to change. They just keep doing what they do. And they make more money selling you something about managing you well, and the steak dinner is basically the purest expression of that mismatch.
I think that sucks.
In a weird way, Jerry, that is actually the most hopeful part of this whole show. Because if the gap is not about secret knowledge, it means the gap is closable. All you have to do is find a firm that is built around the 4 decisions we just listed. You don't need to be a stock picker yourself. You don't need to have a finance degree. You just need to compare, ask questions, and find the right team.
Let me add one more story while we're on it. I had a woman call in last fall. She had inherited money from her father, and she was paying 1.75% to a very well-dressed advisor at a firm I will not name. And she had never once been shown a benchmark comparison. She didn't know what the S&P even did. She didn't know what the Dow did. She only knew that every year her statement arrived and the number was a little bigger or a little smaller. When we sat down and we actually pulled the benchmark alongside her returns, the gap was huge. She had, I almost wanted to say that like Trump.
Huge.
Huge.
I can't listen. I can't hear that word, not hear his voice. She had been underperforming by more than 3% a year for 5 years. That is a quarter of her wealth gone quietly.
And the worst part is she kept saying, but he's such a nice guy. Nice has nothing to do with this. Nice is not a return. Nice is not a performance number. Nice is bedside manner. And you don't hire a surgeon because of he's nice, right? Bedside manner alone. No, you don't do that.
Erik, that is exactly right. And folks, this is one of the hardest things to say out loud in a small town like Knoxville here because everybody knows everybody. Your advisor is usually somebody you see at the grocery store, and breaking up with your advisor, it kind of feels sort of personal, doesn't it? Feels like maybe a divorce. And here's the test I basically ask people to run in their own head, okay? If somebody offered you a job today and it paid you an extra $485,000 over the next 20 years, would you take it?
A lot of people would say, absolutely, I'd take it. Well, the 2% improvement is that job offer. It is sitting on the table. You just have to pick it up.
All right, when we come back for segment 3, we're going to take this comparison into the real world. We're going to show you exactly how our team operates compared to both the Fisher Committee model and the steak dinner sales model, and we're going to give you the specific questions to ask your current advisor. Harmless, right? It's me, Erik Ainge, Megan, Jerry, Susan. We'll be right back on the other side. It's the Organized Investor Show on News Talk 98.7.
If you're interested in a more personal learning experience, join us at the Organized Investor Workshops. Erik Ainge and the entire team will be there. The next event is scheduled for Wednesday, May 20th at 6 p.m. at Chesapeake's Restaurant on Parkside Drive in West Knoxville. Attendees will receive a 60-page workbook, a yummy meal, and learn how to get free estate planning documents through our partner Trust and Will. Seating is limited, so reserve your spot at theorganizedinvestor.com or call 865-415-2058. That's 865-415-2058. Erik Ainge is the host of The Erik Ainge Show on 99.1 The Sports Animal, weekdays from 9 to noon. Erik, his wife Susan, Megan Hubbard, and Jerry Goodman are all affiliated with Tennessee Wealth Management and Prospera Financial Services in Dallas.
We're back for segment 3 right here of the Organized Investor Show, brought to you by Tennessee Wealth Management. It's me, Ainge, your host, and in the final segment, we're going to tie everything together. If you're just joining us, segment 1, we broke down the Fisher Investments model, Fisher Investments, where you're paying premium fees for relationship management, not actual portfolio management. Segment 2, we performed an autopsy on the Steakhouse Dinner Seminar and showed you why that free ribeye is really just an expensive sales presentation for something you don't want, disguised as a fancy meal. In the final segment, we're going to show you what real local management looks like in real time and how our Tennessee Wealth Management team operates compared to both the distant committee model and the pressure sales model. We got Megan, we got Jerry, we got Susan. Before we dive in, let's hit some performance numbers one more time. Well, because maybe they didn't hear them or maybe they did, and I kind of think they ought to hear them again.
All right, let's go. 2025 performance, 36.3% net of all fees and costs. 3-year average, 19.3% annually. 5-year average, 13.3% annually. 7-year average, 16.7% annually. These are all verified and posted at our website, theorganizedinvestor.com. So, Dad, let's get into what is actually happening right now in the markets and how our approach handles that.
Thank you, Megawatt. So 2 things are basically dominating the conversation this spring about these portfolios. Number 1 is what's called AI software sell-off that ripped through the market really over much of the last year. So we saw this as a great opportunity. Not a reason to panic, not a reason to sell, but basically an opportunity to go out and add some very high-quality companies to the portfolio that we haven't seen in over a year. And because we manage all of this in-house, we're able to move very quickly. We saw this as a buying opportunity while everybody else was running for the exits.
And this is where the flexibility really shows up compared to both Fisher's committee model and the mutual fund approach that most steak dinner advisors push. At Fisher, that 5-person committee would have met and discussed and deliberated and then implemented changes across 200,000 client accounts, okay? So by the time they moved, the opportunity, it would probably be gone. At a mutual fund, the investor can't really do anything other than, buy more or sell some of it, but it's all or nothing because you can't divide up the mutual fund shares. The funds usually have mandates, sector weightings, internal rules about how quickly they can add to a position. At Tennessee Wealth Management, we look at the names, we look at the cash flows, we look at the balance sheets, and then we decide when the price is right, when to strike, when to buy, when to sell. That's the difference between owning a business and being stuck in a committee.
And here is what is fascinating for somebody learning this stuff for the first time. During the AI sell-off, what we were really doing was applying the dividend growth philosophy, but opportunistically. The core of this portfolio is dividend growth companies. Those are the anchor. They are steady, they compound, they raise dividends every single year. But surrounding that anchor, we have the flexibility to add when fear shows up. These are what we call bargain opportunities. COVID in 2020, the banking crisis in 23, the tariff scare in 25, the AI sell-off in 26. Fear creates mispricing, and we take advantage of it.
And this is where the football analogies come in for this segment. Okay, here we go. When you're running a 2-minute drill and you need to move the ball down the field and you don't have time for 10 huddles and a whole bunch of play calls and time, you don't have time to call a committee. You don't have time for an offensive coordinator to second guess a play call. You run the no huddle. You read the defense, you snap the ball, and then you react to what you see. That's what this team is doing during a fear event. COVID, banking crisis, the tariffs, AI sell-off, Iran conflict. All of this is 2-minute drill. We don't freeze. We don't panic, right? We don't wait for a fund manager in New York to call us back. We call a play, we run the offense.
And Eric, the other thing about this 2-minute drill is that you have to have practiced it, okay? You can't just walk out and do the 2-minute drill cold. The reason this team that we're on, the reason we can move so fast is because the playbook has been built over 43 years of my experience dealing with this industry over decade. When fear shows up, there's no panic in the building. There's just a play that's already been written out for that particular moment. And then there's the Iran conflict, which basically was another whole animal. This is a geopolitical event, not a market event, but of course it affects the market because everything affects the market eventually. So 2 things jumped out to us at that particular time. Travel stocks got hit, so we bought some of those. And then the oil stocks had gone up a bunch, so we got rid of some of those. Those are 2 completely different trades, but you have to be flexible enough to know how to play both sides of that.
On the travel side, we looked at the fear. People worried about flying, people worried about cruises, people worried about booking vacations overseas. And we asked, is this a permanent change or a temporary fear? Well, after 9/11, travel stocks got destroyed and then recovered completely within 2 years. During the initial COVID outbreak, same thing happened. Ukraine conflict, same pattern. The key is distinguishing between permanent shifts in behavior and temporary fear reactions. Most geopolitical events create temporary fear that, can create buying opportunities for patient investors, that is.
And on the oil side, we didn't chase it. We already had positioned a lot of high-quality energy stocks through our diversified core portfolio. You don't have to be a hero. You just need to be kind of early and kind of consistent. Flexibility plus philosophy equals opportunity. And you don't get that from a steak dinner. You don't get that from a Fisher committee that has to coordinate decisions across 200,000 accounts. You get it from a local team that knows you personally and can move when the opportunity presents themselves.
And Jerry, can I ask a follow-up that I think listeners are wondering? When you say you were buying during the AI sell-off, what does that actually look like day to day? Because in my textbook, it sounds abstract.
Great question, Susan. And the short answer is it's not glamorous. We come in, we watch the list, it gets updated every week. And when the names get on the list, they hit the list, we go through there and we'll move. We'll pick up some. It's not a war room. We're not like something off a movie where we're shouting words or names across the room at each other.
Well, we do that.
Well, that's true, but it's not about the market. It's usually about when we're going to go to lunch. It is a disciplined process of knowing which of those 15 or 20 names we want to move on. And, if when they get cheap enough, when do we want to actually pick those up? During the AI sell-off, some of these names came to us, so we bought them. That's it. No drama, no headlines, no steak dinner required.
And right here in the middle of this segment, I'm going to hit you with our workshop again, guys, because this is what people need to hear. You need to hear about an alternative to all those other things that are out there. It's us. It's the Organized Investor Workshop, monthly at Chesapeake's on Parkside Drive in Knoxville, 6 p.m. You get a good meal, adult beverages, about a 60-page workbook, and we talk about our free estate planning documents through Trust and Will. You could win a signed football from me. This isn't Fisher Investment sales presentation where you hear from a committee about a committee you're never going to meet. It's not a steakhouse environment where you're being softened up for an annuity pitch that if you don't buy, your life is over. It's just an educational, you come hang out with us, you meet us, and you see what we're all about.
So this is Chesapeake's. It is casual, okay? It's relaxed, it's educational, and, there's zero pressure. And if you get to know my dad, you'll realize very quickly that he's a pretty casual guy. Like, he's wearing flip-flops 362 days of the year. There's a couple days in there that it might snow and he may wear tennis shoes.
When I grow up, I want to be like Jerry.
Weddings or funerals also wear regular shoes.
Yeah, he is respectful of those who have died and those who are getting together in marriage. So anyway, so come as you are. You can sign up at theorganizedinvestor.com. So reservations are limited. So please go there to register yourself. And if you want to bring a guest, you'll tell us that on the website. You can also call at 865-415-2058, and you can make your reservation by calling that reservation line. If you have ever been frustrated by advisors who cannot answer your questions because they have to check with someone else, come to a workshop and see the other side of this industry.
And as a Series 7 student in this room, the contrast is wild to me because everything in the textbook is about disclosure, disclosure, disclosure. And yet the reality in the industry is that disclosure, well, it's buried. Here it is on the front page of the website. Performance numbers tied to real client accounts with the last 4 digits of the account numbers printed so you can verify. You can go look. And then compare it to the Fisher's website and see if they post the same detailed performance verification. I'll tell you, they don't. Compare it to your current advisor and see if they post the same. And guess what? They won't.
And I want to add one more thing on this transparency piece, because I think it's what makes the comparison to Fisher and that steak dinner model basically so stark. At our website, theorganizedinvestor.com, you can see real performance numbers tied to real clients with basically verification. At Fisher, you get some sort of generic marketing material, access to a committee that you're never going to meet. At the steak dinner, you're going to get this hypothetical illustration in this great laminated brochure. Looks pretty, but where's the rates of return? One of those is simple math, which is ours. The other two, they're marketing. And when you're picking somebody to manage your retirement, you want math, not marketing.
And let me give you the philosophy in one sentence before we close. We are trying to improve performance by at least 2% per year, net of fees over time, and we get there through in-house management. Currently, we own about 95 stocks at roughly 1% each. Dividend growth companies are the core of these stocks. We also did some opportunistic buying during fear events like COVID, the banking crisis, tariffs, and most recently, the AI disruption for software stocks and the war in Iran. We have the most honest and transparent website you will find anywhere. I mean, I think Dad's underwear size might be on there.
And also our performance numbers are right there along with the last 4 digits of 198 client accounts. And you can look at right there, top to bottom, boom, clients can do it on their phone. And the workshop, on top of all that, we help you with free estate planning documents through our online partner, Trust and Will, at no extra cost to you. Free, Jerry, right?
Exactly.
As in actually free. You get the 60-page workbook, a real meal, real conversation, no pressure. That is our counterweight to both Fisher Committee model and the steak dinner industry. It's what we do.
And let me be direct with the listeners for a second, okay? I'm going to talk to you like I would maybe talk to my first graders who were being unruly one day.
You're going to threaten them? You're going to threaten them?
I didn't threaten kids. Sometimes you have to have your teacher voice.
As far as we know.
So if this conversation has made you even a little uncomfortable about your own current situation, good. The discomfort is information. That is your gut telling you that something has not been right for a while and you have been too polite to look into it. The workshop is a place to look into it. Nobody there is going to make you feel stupid for asking a basic question. And in fact, the basic questions are actually the best ones. And somebody else in the room probably has those same questions.
So let me add one more real world piece of application before Erik takes us out of all this. The selectivity that we talked about all this entire show, the flexibility, the local management, it all comes down to this. We're not trying to be all things to all people. We're trying to be the right thing for the right people, okay? If you want to pay premium fees for relationship management while a committee in some other state makes your actual investment decisions, Fisher's probably a good fit for you. If you want to be sold a product over some expensive dinner, there's plenty of steakhouse seminars coming out every single month. You can go to one of those if you wish. But if you want someone locally who knows you personally, who can explain every trade, every move fast, with opportunities when they present themselves, and they post their track record literally publicly for you to verify, then maybe we should have a talk.
And this is where I'm going to close the show out, or start to anyway, because we've covered a lot today and I want to leave you with clean action steps, right? Let's simplify this. Here's what I want you to do this week. First, if you currently work with Fisher or a firm like Fisher, call your investment counselor, air quotes, and ask them to explain the last stock purchase made for your account. Just ask. If they bought you a mutual fund or an exchange traded fund, ask them why they even bought that. Ask them specifically why that company or fund was chosen over other alternatives. Ask them what the expected return is and what the risk factors are. These are basic questions. If they have to check with someone else, you know exactly what you're paying for.
Second, pull out your most recent statement and look for your performance numbers compared to the Dow or the S&P. If those numbers are not clearly displayed, ask why. Ask for a written comparison of your returns versus relevant benchmarks for the last 1, 3, or 5 years. And if they can't provide that immediately, ask yourself, what are you paying them to do?
And third, go to theorganizedinvestor.com, which is our website, and compare our verified track record to whatever it is that you're currently getting from your own portfolio. See, look at the account number verification that we provide. Ask your current advisor, do they post this same level of transparency? If your current advisor is doing a great job, you'll know it. But if they're not, that 2% improvement that we're talking about, basically that equivalent to $485,000 over a 20-year period, that's an opportunity for you, okay? This is not a marketing promise. This is compound mathematics, and it's worth at least a phone call.
If you'd rather just come to our workshop and see for yourself, you can reserve your seat at theorganizedinvestor.com, or you can call us at 865-415-2058. No committee in another state making your decisions. No surrender period locking up your money. No lockup preventing you from leaving if you're not satisfied. Just a meal, a workbook, a football giveaway, and a chance to be a better informed investor than you were when you walked in.
And one more football analogy as I get ready to take us home here. The best quarterbacks in the league are not the ones with the flashiest highlight reel. They're the ones who can read a defense, make a good decision under pressure, protect the football when it matters most. They know their receivers personally. They understand the game plan intimately. They can audible at the line of scrimmage when they see the defense is trying to disguise them like a steak dinner. And that is what real financial management looks like too. That's us, Tennessee Wealth Management.
It's not the committee in another state making decisions for 200,000 clients that they've never met, okay? That's not us. It is not the flashy presentation over that steak dinner designed to distract you from basically the lack of real performance data. It is the disciplined read on the market conditions, the good decisions made with your specific situation in mind, and the protection of what we've already built. Jared and I, we read the defense every single day, and that's why these numbers basically are what they are.
We showed you the Fisher Committee model. We cracked open the steak dinner, and we showed you what local, personal, transparent management actually looks like. The choice is yours, and now you have the vocabulary to make it yours. I'm Erik Ainge, along with my wife, Susan Ainge, Jerry Goodman, and Megan Hubbard. Thanks for listening to us right here in this edition of the Organized Investor Show. And remember, at our workshops, the only thing truly served is the truth. We hope to see you there. Don't forget, theorganizedinvestor.com, and you can join us right here on the show next week. It's the Organized Investor Show, brought to you by Tennessee Wealth Management.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of the Organized Investor or Tennessee Wealth Management. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional investing advice. Erik Ainge is the host of the Erik Ainge Show on 99.1 The Sports Animal weekdays from 9 to noon. Erik, his wife Susan, Megan Hubbard, and Jerry Goodman are all affiliated with Tennessee Wealth Management in Knoxville and Prospera Financial Services in Dallas, Texas. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning or before making any investment decision. And please consult legal or tax professionals for specific information regarding your individual situation. Brokerage and advisory services are provided by Tennessee Wealth Management through Prospera Financial Services, Inc., member FINRA SIPC. The Organized Investor is a brand name operated by Tennessee Wealth Management for educational platform purposes. Want to meet the team from the Organized Investor in person? Join us at a free Organized Investor workshop. You'll get a 60-page workbook, a great meal, and learn how to get free estate planning documents through our partner Trust and Will. Our next workshop is Wednesday, May 20th at 6 p.m. at Chesapeake's Restaurant on Parkside Drive in West Knoxville. There's no cost or obligation to attend, however, seating is limited. So reserve your spot at theorganizedinvestor.com. or call 865-415-2058. That's 865-415-2058.